There's obviously some reasons why we might be skeptical about the continued strength out of China. And at the same time, we keep getting this drip of data points which suggest optimism, the latest being the travel numbers, that they're not as bad as we might have feared in terms of airline ticket booking and so on ahead of Golden Week. Why reduce your overweight?
Yeah, good morning. So, I mean, for us, we had been, we fully participated in the reopening trade that started from Halloween last year. But I think we're definitely into the second stage, which, if you compare to other reopening stories around the world, consumer travel started to pick up in the second stage. So that's definitely expected. But one part of the, I guess, reopening of China that we're concerned about is it's also a reopening of geopolitical risks. You've obviously got, issues around semiconductors, Taiwan, both related. We think issues like this make it much harder to be outright overweight on China. So, as you said, we've reduced our overweight to neutral on China.
So what is the risk? How are you calculating the risk that all of these comments that we're hearing that are pretty prickly on both sides, from America and from Chinese ambassadors, from Xi Jinping himself, that will spill over into something real?
Yeah, I mean, that is definitely the risk. I mean, you have to expect that there's also some back-channel communication going on, so we don't just take what's in the public at face value. But there's some very, very real issues, and the back and forth around semiconductors is really kind of the more acceptable part of what is the ultimate resolution of Taiwan. So these are obviously very, very big issues for us. We think it's a reason not to be overweight, and we find more interesting stories in different markets outside of China.
Tell us about some of those interesting stories, because I know commodities is one of them. You can't get away from the China exposure for that either, right? If you're watching how iron ore is playing out at the moment.
True. So So a few things. We like Europe better than the U.S. We think that it's become more likely that Europe will be able to avoid recession, and in that case, we've got some pretty attractively valued markets and sectors in Europe. Within the U.S., so we're underweight view on the U.S., but there's obviously lots of interesting stories there. We still think. The most important thing is the end of rate hikes in the U.S., which is, we're very, very close to that, we think. But we also don't expect that we're anywhere near rate cuts. We think this year you won't see rate cuts out of the U.S. And part of the reason is inflation is proving to be very, very sticky, we think. Even what you mentioned around oil demand from China, this is also, an inflationary driver. So we think there's no rate cuts this year. Into that, we think that at this period in a rate hike cycle, normally you would see the growth underperform and sort of value quality types of styles outperform. And obviously we're getting the opposite of that, with tech being pretty strong so far this year. So we were very interested in what's happening with tech earnings, and they're a little bit heavy over the course of this week.